Your credit score is invisible until you need something expensive. An apartment, a car, a credit card, a personal loan, a house. That is when the numbers suddenly becomes very real. At 450, lenders decide how much risk they see. At 810, lenders start competing for your business. Same person, same income, sometimes even the same car. But a completely different price for borrowing money. This is your life at every credit score level, from 450 all the way to 810. One important note before we begin, you do not have only one credit score. Different lenders can use different bureaus, scoring models, and industry-specific scores. Your income, debt, down payment, credit history, and the lender's own rules also affect the final decision. The car loan examples in this video use a $25,000 used car loan for 60 months and current average APRs by credit tier. They are examples, not guaranteed offers. Let's start at the bottom. Your score is 450. You know the number is bad. You just do not know how expensive it is yet. Maybe the report has missed payments, collections, a charge-off, a repossession, maxed out cards, or several years of financial decisions that looked small when they happened but became one large problem on the report. You apply for a regular credit card. Denied, you try another one because maybe the first bank was just being difficult. Denied again. The third application goes through. The bank approves you for a secured card. But first, you must give the bank your own money as a security deposit. You deposit $300. Your limit is $300. The bank is not lending you trust yet. It is renting your own money back to you. You apply for an apartment. The landlord pulls a tenant screening report. You are not automatically rejected everywhere, but the conversation changes. They may want a co-signer, a larger security deposit, additional rent in advance, or proof that your income is much stronger than your credit history. Landlords can use credit and tenant screening information when deciding whether to approve an applicant or require a larger deposit. Then you need a car, not a luxury car, not a new SUV, just something reliable enough to get to work. You find a used car for $25,000. At the current deep subprime average of 21.77% APR, financing it for 60 months creates a payment of approximately $687 a month. By the end of the loan, you have paid approximately $16,232 in interest. Not for a better car, not for extra features, not for a warranty, just for the privilege of borrowing while your credit profile looks dangerous. The lender did not improve the car. Your credit made the money expensive. Your insurance may also cost more in states where insurers are allowed to use credit-based insurance information. That insurance score is not exactly the same as your regular credit score, but information from your credit history can still affect the premium in many states. At 450, the system does not completely ignore you. That would almost be easier. Instead, it offers you expensive access, a small card with a deposit, a car loan with a painful rate, an apartment with extra conditions, a personal loan with terms you probably should not accept. The first rule of 450 is simple. You are not choosing the best offer. You are trying to find any offer that survives the application. Your score is 530-something has changed. Not enough to feel comfortable, but enough to notice. You have made several payments on time. One collection is no longer reporting. Your card balance is lower. The score moves from 450 to 530. Now banks may start saying, yes, that sounds like progress, and it is. But the word approved becomes dangerous at this level. You receive a credit card offer. $500 limit, high APR, maybe an annual fee, maybe a monthly maintenance fee hiding inside the agreement. You see approved and feel relieved, but you have to slow down. Because a bad approval can cost more than a denial. A denial embarrasses you once. A bad approval charges you every month. You return to the dealership. The same $25,000 used car now falls into the broader subprime pricing category at the current average of 19. 42% APR, your payment is approximately $654 a month. Total interest is approximately $4,258. Your score improved by 80 points. You saved almost $2,000 in interest. That is real progress. But you are still paying more than $14,000 simply to finance a $25,000 vehicle. The bank says yes, but the yes still hurts. You apply for another apartment. This time you are not immediately dismissed. The landlord looks at your income, your rental history, your deposit. Maybe they approve you with conditions. At 4:50, the door felt locked. At 5:30, it opens 2 inches. Enough to see inside, not enough to walk through comfortably. This is also the level where people start applying everywhere. One secured card, then a store card, then a personal loan, then a car loan. Then another card because a website said you had excellent approval odds. Now the report has 5 new inquiries. The score that was beginning to recover starts moving backward. The problem is not that you were trying. The problem is that you were trying to solve damaged credit by repeatedly asking for more credit. At 5:30, your job is not to collect approvals. Your job is to prove consistency. One small card, low spending, every payment on time, no unnecessary applications, no maxed out balances, month after month. The second rule of 530, the system has started giving you chances, but every chance still comes with a price. Your score is 610 now, the progress is visible. You have more than a year of clean payments. The secured card may have graduated depending on the issuer. Your deposit may be returned. You have 1 or 2 open accounts reporting positively. Your balances are controlled. You are not in strong credit territory yet, but you are no longer standing at the bottom. You apply for a basic unsecured card. Approved, the limit is not impressive. Maybe $500, maybe $1,000. The APR is still high. But there is no security deposit. For the first time, a bank is trusting you with its own money instead of holding yours first. That feels different. You use the card for gas, maybe one subscription. You pay it in full. The limit is small, but the account is doing its job. It is creating positive history. Now you look at the same $25,000 used car. The current near prime average is approximately 14.03% APR. Your payment falls to around $582 a month. Total interest drops to approximately $9,926. At $450, the interest was more than $16,000. At $610, it is below $10,000. Same car, same loan amount, same 5-year term, different price for money. This is where you begin understanding that the score is not just about getting approved, it is about how much approval costs. Homeownership may also become technically possible. FA's general minimum structure allows a 3.5% down payment for eligible borrowers at 580 or above, while scores between 500 and 579 generally require at least 10% down. Individual lenders can still impose stricter standards, and approval depends on the complete application. So at 6-10, you may qualify on paper. But qualifying and being financially ready are not the same thing. The rate may still be expensive. Mortgage insurance adds another cost. Your savings may be too small. Your debt-to-income ratio may be too high. The lender may want cleaner recent history. This is where many people rush. They hear that 580 can qualify for FA financing, so they immediately start house shopping. But the minimum score is not the goal. The goal is an affordable loan. A lender saying yes does not make the payment safe. At 610, you have moved from almost no options to several options, but the options still require careful reading. The third rule of 610, your credit is finally working. It is just not working cheaply yet. Your score is 650. The file looks different now. 2 years ago, every application felt like a confession. Now it feels like a normal financial decision. You have 2 credit cards. The limits are higher. Your balances are lower. The collection that did not belong to you was corrected. The old charge-off may still be there, but it is older. Time is beginning to reduce the weight of the past. You apply for an apartment. The landlord still reviews the report, but this time you receive the normal deposit. No cosigner, no additional months of rent, no special meeting to explain your entire financial history. You were simply approved. That ordinary experience feels extraordinary when you remember 450. Credit card offers also improve. You may begin seeing no annual fee cards, basic cash back, better fraud protection, possible credit limits in the thousands instead of the hundreds. You are no longer paying a fee just to prove you can manage a card. Now the card may start paying you a small amount on purchases you were already making, but 650 sits in an uncomfortable place. It is high enough to receive approvals. It is not always high enough to receive the best pricing. For mortgage borrowers, the CFPB says people in roughly the 620 to 680 range generally face the highest rates and fewest choices, while those below 620 often have trouble qualifying at all. That means 650 is progress. But it can still be expensive progress. You are inside the building now. You are just not sitting in the preferred section. And this is where many people make the wrong move. They see the score improve. Then they stop reviewing the report. They leave one incorrect late payment untouched. They ignore a collection appearing differently across all 3 bureaus. They keep one card reporting at 90% because total utilization still looks acceptable. They apply for 3 new accounts because approval finally feels possible. Then the score falls again. This is the point where credit repair has to become precise, not random disputes, not templates claiming that every account is fraud, not challenging accurate information simply because it hurts. Pull all 3 reports. Check whether the accounts belong to you. Check balances, statuses, payment dates, collection ownership, duplicate debts, late payments, old addresses, and information appearing differently across Experian, TransUnion, and Equifax. Your reports may contain different information, and one error can affect a lender's decision even when another bureau looks clean. At 650, the file is close enough that small improvements can matter, but it is also fragile enough that careless applications can erase them. The 4th rule of 650, the door is open. But you are still standing in the expensive lane. Your score is 690. Now you are inside the FICO good range. The number no longer looks like an emergency. It looks respectable. Your credit history is cleaner. Your balances are low. You have several accounts reporting on time. The recent damage is gone. The old damage is losing influence. You return to the same $25,000 used car example. At the current prime average of 8.77% APR, the payment falls to approximately $516 a month. Total interest falls to approximately $5,970. Compare that with $450. At $450, the estimated interest was $16,232. At $690, it is approximately $5,970. That is more than $10,000 saved on the same vehicle. You did not negotiate $10,000 off the price. You did not find a hidden rebate. The cost fell because your risk profile changed. Now mainstream rewards cards become realistic targets. Cards such as Chase Freedom Flex currently offer no annual fee and rotating 5% cashback categories, while American Express Blue Cash Every Day offers no annual fee and 3% cashback in select everyday categories, subject to caps and terms. Approval is never guaranteed by a score alone. At $530, you paid fees for access to credit. At $690, credit begins rewarding spending you were already doing. That is a complete reversal. The mortgage conversation also changes. The CFPB's current example compares a $360,000 conventional loan with a 625 score against the same loan with a 700 score. The possible offer ranges overlap, but the higher score borrower generally receives more affordable choices. Comparing the highest 625 score example with the lowest 700 score example creates a difference of up to $264,523 in total interest over 30 years. That is why approved is not enough. Two people can both buy the house. One may spend hundreds of thousands more for the money. At $690, you qualify for many products, but you are still close enough to the next tier to see what you are missing. A slightly lower mortgage rate, a larger starting limit, a cleaner pre-approval, a better refinance offer. You are approved. You are competitive. But you may not always receive the bank's best price. The fifth rule of 690, the system trusts you now. It just does not compete aggressively for you yet. Your score is 730, you did not find a loophole. You did not buy a trade line and become wealthy overnight. You did not send one magical letter and wake up with perfect credit. You kept paying. You kept balances low. You stopped applying for accounts you did not need. You allowed your positive history to age. That is how you reached 730. Now the language around your credit changes. You begin seeing pre-selected, pre-qualified, special offer, excellent credit recommended. The offers are coming toward you now. You are no longer refreshing approval websites at midnight. You are deleting offers because you do not need another card. That is a different kind of power. You may become competitive for travel cards such as the Chase Sapphire Preferred, which currently carries a $95 annual fee and offers travel rewards and protections. But the issuer still considers the complete profile, including recent accounts, income, debt, and its internal rules. At this level, the question changes. At 5:30, you asked, "Can somebody approve me?" At 7:30, you ask, "Which offer gives me the most value?" You enter the dealership with a bank or credit union pre-approval. The finance manager gives you a rate. You do not celebrate. You compare it. You ask whether they can beat your lender. You negotiate the car's out-the-door price without allowing the entire conversation to become about the monthly payment. Bad credit makes you chase approvals. Strong credit makes approvals compete. The mortgage conversation improves too. The CFPB says borrowers around 680 to 740 typically pay somewhat higher mortgage rates than those in the mid to high 700s, but they generally have more options than borrowers in lower ranges, so 730 is strong. But the best mortgage pricing may still be a few dozen points away. This is why you protect the file. No large card balances before closing. No furniture financing while the mortgage is being processed. No new car loan the week before final approval. No random card application because you saw a bonus online. One careless decision can change the debt to income ratio, lower the score, or force the lender to review the file again. The sixth rule of 730, you have stopped asking for permission. Now you are comparing options. Your score is 770. The score is now in FICO's very good range. You have years of payment history, older accounts, low balances, few recent inquiries, no new collections, no recent late payments. The file is no longer trying to prove that you changed. The file now shows that responsible behavior is normal for you. Mortgage lenders like this range. The CFPB says the lowest mortgage interest rates generally go to borrowers with scores in the mid to high 700s or above, and these borrowers typically have the most choices. That does not mean every 770 borrower gets the same rate. One person may have a large down payment. Another may have high debt. One may have stable income. Another may be self-employed with inconsistent documentation. The score opens the conversation. The full financial profile determines how good the conversation becomes. Credit card limits may also become larger. Premium travel cards become more realistic. Balance transfer offers become stronger. Business card approvals may become easier when the income and business profile support them. But something dangerous happens at this level. The system trusts you with more debt, a $20,000 credit limit, a $40,000 vehicle approval, a large personal line, a bigger mortgage. The lender's confidence can make you feel richer than you are, but available credit is not income. A $20,000 limit does not mean you can afford to spend $20,000. It means the bank believes you are likely to repay it. Do not use a strong score to create a weak financial life. Use it to lower costs. Earn rewards on planned spending. Protect cash flow. Negotiate better terms. And reject debt that does not improve your life. At 450, you accepted the only lender willing to speak with you. At 770, you can leave the dealership. You can reject the personal loan. You can choose a different card. You can shop several mortgage lenders instead of accepting the first quote. The ability to walk away is worth more than any metal credit card. The seventh rule of 770, credit is no longer a barrier. It is negotiating power. Your score is 800 tone exceptional. Not perfect, not guaranteed. Exceptional, your oldest account may be more than a decade old. Your utilization is low. Every payment is on time. Your report has no recent damage. You do not apply for credit often because you already have the accounts you need. The system sees stability. Now return to the same $25,000 used car one final time. At the current super prime used car average of 6.30% APR, the estimated payment is approximately $487 a month. Total interest is approximately $4,209. At 450, the same example produced approximately $16,232 in interest. The difference is more than $12,000. Same $25,000 car, same 60 months. The number on the credit file changed the price by more than $12,000. For new vehicles, the current super prime average is approximately 4.55% compared with 16.01% for deep subprime borrowers. At 8-tone, your credit card decision is no longer, what will approve me? It becomes, which rewards actually fit my spending? Cashback, travel airport lounges, purchase protection, business expenses, no annual fee, premium benefits, you choose based on value. But even at 8-tone, approval is never automatic. A bank can still deny you because of income, debt, recent applications, internal policies, a frozen credit report, identity verification problems, or an existing relationship with that issuer. The score is powerful. It is not a command. The mortgage lender still checks your income, savings, assets, debt, and complete credit history. But the score is no longer the part of your application making everything harder. The lender sees low risk, and low risk creates choices. That is the real luxury of an 810 score. not the premium card, not the large credit limit, not the pre-approval letter. The luxury is saying no. No to the 72-month car loan. No to the overpriced mortgage. No to the card with benefits you will never use. No to financing a lifestyle your income cannot support. At 450, the lender controls the conversation. At 810, you can control whether the conversation continues. The eighth rule of 810, the score does not make you wealthy. It makes borrowing cheaper and bad deals easier to reject. The full journey at 450, you search for anyone willing to approve you. At 530, approvals appear, but they are expensive. At 610, rebuilding becomes visible. At 650, the doors open, but you remain in the costly lane. At 690, lenders begin respecting the file. At 730, you stop chasing offers and start comparing them. At 770, credit becomes negotiating power. At 810, lenders see an exceptionally low-risk borrower. But understand something important. Your score does not measure your value as a person. It does not know why the payment was late. It does not know that you lost your job. It does not know that a relationship ended. It does not know that one emergency became 3 emergencies. It looks at the information inside the report and predicts risk. That prediction can affect credit cards, loans, rental housing, credit limits, interest rates, and, in states where it is allowed, insurance pricing. And sometimes the report is not telling the truth. An account belongs to someone else. A payment marked late was paid on time. A closed account still shows open. A collection appears twice. The balance is wrong. The dates are wrong. The same account reports differently across the 3 bureaus. That is where legitimate credit repair begins. Get your reports. Review every account. Compare Experian, TransUnion, and Equifax. If information is inaccurate, incomplete, duplicated, or not yours, dispute it with the credit bureau and the company that furnished the information. Include supporting documents. Explain exactly what is wrong. Do not send vague disputes. And do not dispute accurate information simply because it is negative. The CFPB specifically recommends checking for accounts that are not yours. Incorrect late payments, closed accounts reported as open, wrong balances, and duplicate debts. Then work on what you control. Pay every account on time. Lower credit card balances. Apply only when the account serves a real purpose. Do not finance something just because you qualify. Keep older no-fee accounts open when they still make sense. Build emergency savings so the next surprise does not become another missed payment, and give the process time. Because credit repair can correct an inaccurate file, but strong credit habits are what keep the file clean afterward. Your credit score is only a number. But that number can decide whether money works against you or works with you. So do not chase the next approval. Prepare for it. Fix the report first. Strengthen the profile. Then choose the car. Choose the card. Choose the home. And choose the lender from a position of power. Because bad credit asks, can you get me approved? Strong credit asks, can you beat the offer I already have?